We'll just mention in brief how market tops are mentioned in the MarketSmith application. So within the application, we will as soon as you open it, the market status will be displayed at the front. So it will say confirmed uptrend or uptrend under pressure or correction and so on. That is just a quick look. If you want a more detailed view, you can go for the market outlook section where we will be talking about what the market is doing and so on. Okay, so this chart is showing some of the historical calls that we have made with regard to market direction. So when did we call a rally and when did we call a downtrend? So all these red arrows that you see are when we had called that the market is now entering into a new downtrend, and all the green arrows that you see are when we call that market is entering into a new uptrend. So as you can see. It is a fairly reliable system that we use. Again, it's based on distribution days, and we'll talk about distribution days in the coming slides. So, as you can see, it is fairly reliable. It is not 100% accurate. In our view, it's not really possible to become 100% accurate in trying to time market uptrends and downtrends. But we do believe that it is possible to catch an uptrend in the fairly early stage, as you can see here. So we didn't really catch the bottom, but we did manage to catch fairly early that the uptrend is starting, as well as spotting tops. As you can see in this particular top, we did not catch the exact top, but fairly early stage of the downtrend, we recognize that we are starting to enter a downtrend. And as you will see in many of the stock examples, these kind of calls helped us to protect a lot of our profits. Okay, so moving on to distribution days. What do we mean by a distribution day? So distribution day is defined as when any of the index closes down by more than 0.2% with volume that is higher than the previous day. Uh, so now you should be a little bit careful here. What we're talking about is that volume is higher than the previous day and not necessarily above average. It may be above average. Sorry for that pause. Let's move on. So this is how we define distribution days. So when the market is down by 0.2% or higher, and the volume should be higher than the prior day. Now that's what we call a distribution day. Why is it? Why is that term? Why is there the specific term of distribution day? The meaning of it is that there is a broad distribution in the market. What that means is overall in the market, people are selling shares. So what we mean by distribution is that people are mostly selling off shares. So when we see that index is down by 0.2% or more, based on our studies, that happens when most of the participants in the market are into a selling mode for that day. So the more technical term for that is called distribution, and that's why it's called a distribution day. So how do we know that the market is entering a downtrend? We count how many distribution days we have in any span of 5 weeks. So standing at today, we will look back 5 weeks. 5 weeks is equivalent to 25 trading days. So we look back 25 trading days and we count how many distribution days do we have. Now, if we say that we see that we have 5 or 6 distribution days or more often than not, it indicates that the market is moving into a downtrend. So once again, what we're looking for is a clustering of distribution days over the past 25 trading days. The period we look at is 25 trading days or 5 weeks, and then we try and count how many distribution days do we see in this past period. And we are trying to see, are we seeing distribution days come more frequently or less frequently? Are we seeing distribution days happen consecutively, or are they spread out far between each other? Is there a lot of gap between the consecutive distribution days? All of these things are factors that we will look at, and based on that we will come up with a distribution day count, and that count will determine whether uh, are we moving into a market downtrend or not. So here is an example that is uh, showing you many of the signs uh, that indicate that the market is moving into a downtrend. So all you see, all these points are marked 1 through 5. All of these are particular signs of weakness that we can spot. So the day marked 1 here. This is a daily chart, by the way, and this is Nifty over the period of September to December uh, 2016. So the last quarter of that calendar year is what we're looking at, and we are seeing how the market went from a confirmed uptrend into a downtrend, and what are the signs that we saw. So the first sign is day one. Day one is marked here. So day one is the first distribution day after a long uptrend. So by itself, this does not mean anything. It's just you will see that all of these signs come together, and then finally we realize that now the market is in a downtrend. So day one is this. We see the first distribution day after a long uptrend. So why is this the distribution day? The index was down by more than 0.2%, and if we look at the volumes for that day, they were much higher compared to the previous day, and coincidentally they were also above average. So definitely one is a distribution day. And what happened next? So the point mark 2 here, this day the index gaps down as well as it was the second distribution day. So how many days have passed? uh, Distribution day 1 was here. The next day nothing happened. The day after that nothing happened. The day after that we have the second distribution day. So now standing at day 2 and looking back, we have two distribution days over a period of 4 trading days. So that means two distribution days within 1 week. So something to watch out for. So day 2 is the point mark 2 here is another distribution day. uh, Again, if you see volumes were higher compared to the previous day, and if you see the index actually gapped down on that day. So gap down is something that we will watch out for. It's a sign of weakness. Index gapped down, and it was also a distribution day. So what happened after this day mark day 2? The index managed to rebound a little bit, but then we see the third distribution day coming in. So the point marked 3 here, this is your third distribution day. So third distribution day, again you can see volumes are higher than the previous day. Just like day 2, it's not necessary that volume should be above average. We are only comparing it to the previous day's volume. So here in day 3, you can see volume is higher than the previous day, as well as the index was down by more than 0.2%. So that was day 3. So what happened after day 3? So moving beyond day 3, the index fell pretty sharply on this day marked day 4. So the red line that you see here is the 50-day moving average. So on this day marked as day 4, the index fell below the 50-day moving average. Volumes were very strong. Not only was it above the previous day, it was well above the average as well. So definitely distribution day here, very sharp fall and very strong volumes. So now let's just stand at day 4 and look back and see what happens. So standing at day 4 and looking back over a period of around 3 weeks, we already have 3 distribution days. So 3 distribution days over a span of 3 weeks. Plus, what additional signs do we have? The index is breaking below the 50-day moving average. That was on day 4. We had one gap down day as well. You will see this point marked S as well. I will come to this concept a little bit later. So first we will cover all these days marked 1 through 5, and we'll talk about them, and then we'll come back to what this S means, and we'll talk about this as well. So day 4 is when it breaks below the 50-day moving average, and it was the fourth distribution day. So moving on, what happened after that? So as you can see, the index managed to recover a little bit after day 4, moved back above the 50-day moving average. But again, on this day marked as 5, it again gaps down. That is one thing. It again closes below the 50-day moving average, and this is the fifth distribution day. So in total, we have 5 distribution days standing here and looking back. Uh, Day 5 is when it gapped down as well as it fell below the 50-day moving average. So looking at what happened between day 4 and day 5, the index tried to rally, did not really move up to new highs. If you just look closely, you will see that the index never actually crossed the high on day 4. And then it gapped down on day 5, and it made a loss of more than 0.2%. So that makes the count of 5 distribution days over a span of 5 weeks. Like we mentioned earlier, that is the kind of threshold that we look for. 5 distribution days in a span of 5 weeks is indicating that the market might be entering into a downtrend. So if you just look at this chart, we have seen many other signals apart from distribution days as well. You can see there is a gap down day. You can see there is one more gap down day here. And if you look at this period between 4 and 5, you will see very clearly that the index tried to rally higher, was unable to do so, and then again fell. And okay, let's come to the point marked S. So S is basically what is called as a stalling day. So stalling day is basically we see a very low price movement in the index, but we see very big volume as well. So you can see this day marked S has pretty high volumes. Compared to the previous day, it's quite high. So you can see the closing prices as well. The closing price, while it was positive compared to the previous day, it was very marginally positive compared to the previous day. So the index is not moving much, but there is a lot of volume. So what that means is there is a lot of churn happening in the market. So a lot of shares are changing hands. So many of the people are getting out of the market, and many of the people are buying those shares that the people are getting out of. So some of the big holders are selling their shares, and those shares are being bought by the small holders. So that's why you see that there is not much of price change. If it was the other way around, where small holders are selling their shares and larger holders are buying shares, then you will see a big price change as well, because it's generally the large players like mutual funds who can make a big impact on the price movement in the market. So what you see here is that a lot of shares are changing hands, as you see by volume. But what is happening is that large shareholders like mutual funds are selling shares to smaller shareholders. So it's a kind of churn that you see. And generally, we observe that this kind of action happens toward the end of a market rally. So one more thing to watch out for. So as you can see, it's not only about 5 distribution days. You can see several signs of weakness over this period. So we'll just quickly look at what happened after these 5 distribution days. So these days marked up to 5 would be sufficient to say that now the market is entering into a downtrend. And let's see, what kind of, even if you say you had not spotted all of this and you are trying to determine the market condition, even after this, you can see some signs of weakness where the market is telling you that it's entering into a downtrend. So as I mentioned here, day 4, it fell below the 50-day moving average, tried to rally higher, was not able to do so, fell again back below the 50-day moving average. After day 5, it continues to go up. But again, as you see, a very similar type of action here. So between 4 and 5, tries to rally higher and falls. So beyond 5, falls below the 50-day moving average, tries to rally higher again, but it is not able to break above the 50-day moving average, and then it starts to fall. So after that, and then you see one more gap down day here. So this is another warning sign. And after that, you can see some very big a day where the market fell a lot but managed to recover. The next day, managed market tried to rally higher but again closed near the day's low, and then followed that was followed by another big down day. So these 3 days are very worrying, where you see sharp fall in the market. It recovered, and the next day again the market tried to rally, but again it fell, closed near the low, and the third day after that, the market fell sharply again, and this time it actually closed near the day's low. So similar trading day after that, where it fell below the 200-day moving average as well. So this section that you see here are very kind of sure signs that the market is definitely entering into a downtrend. In case you had not spotted these 5 days, including this stalling day here. Okay, so that's about the kind of action that we will see in the index. So So what are the other things that we can see apart from the index that will indicate that the market is moving into a correction? So one thing is weak abnormal behavior in leading stocks. So leading stocks are the stocks that have been the best gainers in that market so far. So those stocks that carried the market forward or pushed the market toward new highs when the market was rallying. So those stocks that were driving the market higher, those are starting to show signs of weakness, such as late stage basis and climax runs. So we'll talk about these in a little bit more detail. So the takeaway from this slide is that you should watch out for the stocks that were leading the market so far. When they start to show some abnormal behavior or weak behavior, that can also indicate that the market is moving into a correction. So here you have a chart of Ashok Leyland. So this chart goes from September 2013 to September 2016. This is a weekly chart. So this was during uh, this was one of the stocks that was pushing the market higher. So this is one of the leading stocks in the market. So how do you identify that? Very high RS rating, very high upside volume. All those things are telling you that this was a leading stock in the market. So as you can see, this was making many late stage bases. So the best time to buy is in the first or second stage base. So here the first stage base is highlighted, and here the second stage base is highlighted. This stock continued to rally after the third stage base and after the fourth stage base. But once it moved into a fifth stage base without any significant correction, that's when you have to start to kind of get worried. So all these late stage bases where it keeps forming base after base without making any kind of correction, that's when you have to be careful and you have to avoid buying it after these kind of late stage bases, because it is more, the probability is not in our favor. We have seen that the probability is most in our favor when the stock breaks out of a first stage or second stage base. Once we move into these late stage bases, uh, it is more likely that it is going to fail and will lead to correction. So that is a late stage base. Here we are looking at what is called a climax run or an exhaustion gap. So here it is, the stock has been going up 25 to 50%. Uh, the stock has been rallying for some time, but then it goes up 25 to 50% in a span of 1 to 3 weeks. So it has been rallying from its original base of the first stage for several months. So at least 18 weeks, the stock has been rallying. Uh, or if you're looking at something beyond second stage base, at least 12 weeks the stock has been rallying, and then you see that over span of 1 to 3 weeks it goes up significantly, so 25 to 50% in a span of 1 to 3 weeks. That is one sign to look out for. It closes well above the 200-day moving average, so very much extended from the 200-day moving average, so 100% above the 200-day moving average or more. Another sign is the widest price spread since that stock broke out. So looking back at that breakout and how the stock has behaved, if you see the weekly chart and you see the widest spread, so spread means the difference between the low and the high of that particular week. If you see a very big spread, which is the biggest spread since that stock broke out, uh, that's again a sign of a climax stop. Exhaustion gap is something that you see here in is this chart. So the stock has been going up for many days, and then you see again these very big price movements in a single day. So again, you can see the difference between the low and the high is very high, and it makes a big price run in a span of a few days. So 65% in 7 days. And if you notice, these are the biggest difference between the high and low that you can see in this entire chart. So these are all signs that will that indicate that it is a climax run. So exhaustion gap, where you see this kind of huge price run on the daily chart, the biggest difference between the high and low, a very big price run in a span of 7 days, and this is happening after the stock has already rallied significantly from its breakout base. So that's called an exhaustion gap. If you look at the weekly chart, you will see a similar thing where there is a very big difference between the high and the low since that stock broke out from its original base. Also in the weekly chart, you will see that it is more than 100% above the 40 week line. 40 week and 200-day moving average will be roughly the same, not exactly, but roughly similar. So if you see that the stock is more than 100% above the 200-day moving average, so that's when you should be a little bit careful. And if you look at the weekly price run, if you see that it's gone up 25 to 50% in just 1 to 3 weeks after it has broken out from its original base, that's also a sign that it may be a climax run. So all these things are happen after the stock has already broken out and already made a significant price run from its first stage or second stage base. So it's not like it is just breaking out of a first stage base and then it goes up 25%. No, that's good. That's what we are trying to identify. But if you see this happening well after that original breakout, that could be a climax run, and then you should be a little bit careful. So here you can see how extended it is from the 200-day moving average. So 175% above the 200-day moving average. And here you can see very clearly that the price action here looks very abnormal compared to the price action here. So we want to see some steady. This kind of movement is good, where you see some steady up movement in the price. But this kind of movement is something that you should be careful, where you see a huge difference between the days high and the days low, and you see the stock is extending very much above its 200-day moving average. So we mentioned briefly before low quality stocks leading the market. You can see this in our MarketSmith application as well. You can see the leaders up on volume and leaders low on volume. Oh, so this is telling you what stocks are moving up on high volume, what stocks are moving down on low volume. So if you see that the stocks that are, like I mentioned earlier, stocks that led the current rally stage of the market, if they are coming to this list, this down on volume list, which says that they are going down on heavy volume, that is a sign of market weakness. And if you see that the speculative stocks, the penny stocks, or the stocks that have not done very well in the rally stage, they are starting to rally now. So that is something to be really careful of. Uh, Low quality stocks, that is what is termed as low quality stocks starting to lead the market. That is an indication that this rally might be coming into an end.
Hello.
Yeah. So another reason why we should be cautious when if low quality stocks are leading the market is that usually it's the institutional investors who drive the market on the way up. And similarly, when these institutions sell the stocks also, like it usually signals that the market top has been formed and the market generally goes into a correction as well. So with institutional investors, what you see is like they do their own detailed study of the stocks, they do evaluation, see how the earnings are headed. So you see that the institutions generally get into stocks only when like there is enough liquidity. So you see that they get into the larger cap companies and also where earnings growth is likely to be good. So and since these institutions are investing for more for a longer period of time, so they want to see that the stocks they are investing are fundamentally very good and not just stocks which are going to go up over a period of some days or weeks. So that's why for the market rally to sustain, we need to see that the leading stocks should continue to lead the market. And whenever we see these lower priced, low quality or speculative stocks starting to lead the market, that's a sign that people who did not have conviction in the market earlier, they are starting to see that the market is making new highs. So these people are now coming into the market at a late stage of the rally, and which is what is driving the lower price or the low quality stocks on the way up now. And what happens is that the moment some weakness starts coming into the market, these players who do not have too much stake in the stock and who do not have too much conviction, they will start selling off. And so in such a case, like when these without any institutional support for the stock and with these speculative investors who are meddling in the stock market, you see that the market rally would be coming into an end, and once the stock or the market starts falling, uh, usually you see a top being formed. So
So here, this slide is basically telling you what happens to the leading stocks when the market moves into a correction. So we mentioned earlier as well that most 3 out of 4 stocks will follow the market direction. So this you can see this is a prior market rally where these were the top leading stocks, and you can see that this is 2016 by the way, and you can see that as the market entered into a correction, these stocks also significantly started going down. So just because you are holding on to a stock that has done well for you during the rally stage, they as well can correct sharply during a market correction, and you can see most of your profits eroding away. So that's why it's very important to notice when the market is moving into a correction and start reducing your positions accordingly. So here you can see a little bit detail about Asian Paints. It made a top in October 2016. So coinciding with that top, the market already had a high distribution day count. And then you see that the stock is starting to show signs of weakness. So breaks below the 50-day moving average with heavy volume. And few days after that, we moved the market into a correction. And so as you can see, we are not exactly perfect here. There was a little bit delay when the stock started falling, and then we moved the market into correction. So everything is not going to be in sync and perfectly happening. So, but what you can notice from this chart is that by calling the correction here and by observing that the stock was starting to show signs of weakness, we protected ourselves from this kind of market correction where the stock fell below the 50-day moving average and there was a sharp loss and it continued to go much lower. Just to highlight that fundamentals will always lag the technicals in the market. So that's why we look at technicals in the market. We keep on talking about 50-day moving average, high volume for stock falling on high volume, and so on. So the reason we emphasize on all those things is because the technicals, when the market is looking weak, the technicals will start to look weak before you see any kind of fundamental change in the stock. So there is a difference between stock market cycles and economic cycles. So even if the fundamentals are great, so as you can see here, the year over year EPS growth and sales growth for the stock was still very good. If you look at the preceding quarters, while the market entered into a correction, but still the stock went through a heavy correction because overall the market was looking weak. So the market can look weak even if companies continue to have good earnings growth and so on. So that's why we focus on technicals, because technicals will more often show weakness before you see any kind of weakness in the fundamentals of that company. So what we say is don't wait for the company to release their next quarterly income statement and then show that something has gone wrong. When you start seeing signs of technical weakness, that's when we should be selling the stock, and for the overall market as well, that's when we should watch out that the market could be entering into a correction. So moving on, this is basically our last topic for today. How do we do? What do we do when the market moves? When we spot a market top, or when we say that the market is entering into a correction? Uh, so first of all, cut all your losses short. This is goes a little bit counterintuitive to what most people try to do. So most people will hold on to stocks that are making losses in their portfolio, saying that I don't want to sell it at a loss. I will wait for some time and sell it when the stock moves above my purchase price. So that's a little bit of flawed thinking. If you bought it and the stock has gone down, uh, it's probably that it was not a good timing, or maybe you picked the wrong stock. So there is no sense in trying to wait and see that I will sell it only when I am in profits, because you may never get into profits. You might have bought it at the top and now the market is entering into a correction, and for a long period of time it's never going to come back to your purchase price. So we strictly follow our sell rules, and we follow our sell rules even more strictly when we spot that the market is entering into a correction. So our sell rule says that if the stock falls 8 to 7 to 8% below the purchase price, then you should sell that stock. So, like I mentioned, we are even stricter when we see the market is looking weak. So, if you do notice that there is a high distribution day count or the market is moving into a downtrend, then you should not even wait for 7 to 8%. Maybe it would be a good decision to sell your loss-making stocks even before that. Say 3 to 4% loss, you should be cutting those off and selling them. Get off margin. So this is again trying to adjust the risk in your portfolio. So if you have margin, if you're holding stocks on margin, margin will always compound your losses. So it's better to get off of margin and take a less risky approach to the market when you start seeing high distribution day counts and the market moving into a downtrend. And locking in gains. So we mentioned that you should cut all your losses. You should consider booking your profits as well when you notice that the market is moving into a downtrend. The reason for this is many of the stocks will follow the market direction. So some of the stocks in which you have gains, many of those gains might be eroded away, and it will be a little disappointing for you to see a 30% gain become a 15% gain, or a 50% gain narrow down into a 30% gain, and so on. So in order to avoid those kind of situations, when you notice that the market is starting to move in a downtrend, you should look at all those stocks that you have profits in. So pull up a chart for all those stocks where you have gains, and fix a price, or fix a moving average, or fix some level where you will say that at this price I'm going to sell this and lock my profits. So how do you spot, how will our app tell you when the market is moving into a downtrend? So we mentioned that you can count the distribution days. That is one way, and you can also have a look at our daily big picture report that goes out. So we'll always say what the current outlook is. So our outlook right now is still in market in a confirmed uptrend, and other things to watch out for is the leading stocks starting to falter. So our list will tell you the stocks that are leading stocks down on volume and leading stocks up on volume. So if you see a lot of stocks in that leading stocks down on volume section, then that is something to watch out for. And of course, when we change the market condition officially to a confirmed downtrend, of course, we'll be sending out notifications and emails about that as well. So these are the ways that you can keep track of all this. And so coming up in our next presentation, we'll talk about how to spot market bottom. So this is just a tentative topic. So if you think that there is some other topic that you would like us to cover, so we have already gone through all our 12 webinar topics that we believe investors should be knowing about in a little bit detail. So we picked this one because we kind of felt that the market has been rallying for some time, and now is the time to keep our eyes open for any kind of sign of weakness. So if you think that there's something else that you want to know a little bit more detail, so we can cover that topic as well. So if not, this is what we are going to do in the next session. So we'll talk about how to spot market bottoms, and how do you spot a follow through day, and how to start buying when the market is starting to move into an uptrend. So that's all for today. So I will pause the presentation for now, and uh, we will see if you have any questions. You can either ask us, or you can enter them in the chat as well, and we will try to answer them.
Hello, may I disturb you, please?
Yeah, please.
I'm Ajay Srivastava from Kanpur.
Hi, Ajay.
This talk was very informative for the people like us, and I got some idea according to your presentation that right now this Indian market is in top, and it may start tumble in a down way. Is it right?
Uh, we at MarketSmith do not try to predict where the market is heading to, or the level, or try to predict the level as such. So, but generally, what the philosophy that we follow in MarketSmith is that you buy high and sell higher. So it might seem a little counterintuitive for you. So the reason why we are saying like you can buy on a new high is that means at a new high, like people who have already bought into the stock or the market, they are sitting on a profit and they are less likely to sell at that particular juncture. So and so that's when the strength there is usually strength in the market, and you want to see the where the market can take you higher from there. So, but at the same time, we see that like market does not move in a straight line. It has its own ups and downs. So that's why we look at concepts like these distribution days, follow through days, and all. So distribution days usually signify that there is selling happening in the market, like especially by institutional investors. So if right now we are at a stage where like Nifty has 3 distribution days and Sensex has made 4 distribution days. So if such a trend continues and we see more distribution days coming in, that means the selling pressure is accentuating in the market. So in such a case, we'll change the market status to something called like uptrend under pressure. So that will be a time when we should be, when you as an investor should be more cautious about picking new stocks, and also you should be selling out of stocks which are starting to show technical weakness. But otherwise,
All right. Thank you.
yeah,
Yeah.
yeah. But otherwise we would,
Otherwise means,
yeah. But otherwise we would say like with market in a confirmed uptrend, this is a time to look out for stocks which are showing good fundamentals and which are showing technical strength.
right. But in fact, I got an idea based on one or two scripts chart like Cummins India
Okay, comments India.
or another. Very true. Another was this Concord. These two are the basic fundamental scripts. But during these 3-4 days,
Hmm.
they have changed its behavior.
Okay.
So on these one or two graph prediction, I just asked the question whether our market has top out or is start to go down or it will uptrend.
We say market status based on the market indices like the Nifty and the Sensex. So, so,
Right.
so if we come specifically to stocks, then we need to look at charts whether these individual stocks are topping out as such. So let me have a look at comments India as such.
Yeah.
So, looking at this chart, there is definitely some selling pressure going on, but it does not. It's not really showing that it is really starting to look weak or starting to enter into any major downtrend as well. So we still say that there is. It looks like there is still some support that is there further down from here. So yes, there is some selling going on, but it does not say that there is a it is going into a downtrend or something like that. So yes, you can see very big days in which there is very big down volume, but as of now, there are still further support levels even below this.
Right.
And what is the other stock you refer to, sir?
There's a Concord.
Okay, yeah. So if you look at the charts of Concor, that's Container Corporation of India, the chart
Very true.
show a better picture compared to Cummins India. Like if you look at the volumes on the up days and the down days, like yeah, last maybe 1 or 2 weeks, like it has been evenly split between buyers and sellers. Like so it's not showing anything like any selling pressure is accentuating. So right now it's
I,
actually forming a flat base pattern. So and its pivot level is at 1251. So if you see that the stock is
yeah.
breaking, taking out 1251 on the upside, then you can potentially look at buying the stock. However, on the downside, the support should be coming somewhere around actually 1120 actually. So that would be a key support level
Yeah.
for you to watch out for. But at this stage, the stock
Right.
looks reasonably fine. It's not in a daring uptrend as such, but still it's moving sideways.
Right. Right. Thank you.
Yeah, thank you.
We are welcome. Thank you, please.
So I see this question about how do you check leaders up or down on volume from the application. So we'll get to you in just a second.
Okay, so regarding how to find out these leading stocks which are moving up on volume, so what you can do is like you go to the home page of your MarketSmith app on your mobile, then you can click on you have like four sections like market outlook, model portfolio, idea list, and one more. So click on idea list, and once you click on idea list, a dark violet icon will appear on the top left portion of your screen. If you click on it, you will see like India model portfolio under it, under current holdings, recent additions, and so on. And again, under that, like you can see like MarketSmith reports. So there you can see up on volume. So once you click on up on volume, you can see the stocks which are some of these leading stocks which are moving up on volume. So right now in our app, we don't have any feature for a down on volume, uh, but you can definitely see the stocks which are moving up on
So
volume.
if you just look at this list, it is just telling you which stocks are making movements with strong volume. So some of them will be moving up on high volume, some of them will be moving down on low volume. So we don't have a, you can actually sort it, but we don't have anything that separates these into moving up on high volume or moving down on low volume. Okay, so I see some questions about do we have any advanced workshops and so on. So the way we have our workshops, there are two places that you can listen to us. One is every Tuesday, every second Tuesday, every bi-weekly basically. We will have this kind of session where we will go over one particular topic in a little bit of detail. So this will be just a few hours long. But just covering a single topic. And we also have monthly webinars that is held at the end of every month. That will basically cover our entire methodology, and we'll talk about a lot of topics on that day. So we'll talk about fundamentals, technicals, how to time buying, how to time selling, and so on. So it is just an overview of our entire methodology that you will have on those sessions. So that will be a pretty much whole day session, which will be around 5 hours or so. So these are the two formats that we have. Next session is on 19th. And yeah, the next one that we have will be on 19th. Yeah, and the link for that is already shared with all.
Do we upload these sessions on website in case someone misses those sessions?
So sessions are all the recordings of these presentations will be available on our YouTube channel as well, which you can go back and see.
Okay, thank you.
So I see one question about do you have any strategies for swing trading? So for people who are not aware, swing trading is basically you look at the chart and you look at the technicals and you try to I will buy here, buy at this low, and I will sell at this particular high. So while the chart is moving between some kind of base or moving between two particular levels, you try to identify the low level, try to identify the high level, and try to trade between that. So our methodology is quite different from that, where we buy at the high while the stock is breaking out, and then we sell when we start to see some signs of weakness. So this is basically the way that we follow. We don't really follow any other type of trading strategy. So our strategy is basically based on a mix of fundamentals as well as technicals, and it is more geared toward a little bit more longer term compared to what typically swing traders will do. So answer to the question is no. Basically, what we describe as our methodology is what we all follow here. So that looks like we have no more questions for today. So I guess we'll stop the presentation. We'll stop today's presentation now. Once again, thanks for joining us. Our next one
I
will.
have one question.
Yeah, please.
Yeah, I mean, just wanted to know. I mean, can we use? I mean, will you be teaching anything on options and futures derivatives using CANSLIM?
No, our strategy is basically only following equity, so we don't really look at options and futures as such. Our strategy is solely based on, like we mentioned, the stock breaking out of a base pattern when the fundamentals are strong, plus the technical timing looks right. You don't really have any derivative-based strategy for that.
Okay. Okay. Yeah. Thank you.
Okay, looks like that's all. So thanks for joining today. Next one will be on the 19th. As I just mentioned before, if you have any suggestions for future topic, and if we see that overwhelmingly a lot of people are suggesting some particular topic, then we can go over that. If not, then we were planning to talk about how to spot market bottoms in the next session. So thanks again, and goodbye, and have a nice evening.
Well, at the last, I'm Ajay Srivastav. From all the attendee, we people thank you people. It's a thanks to all of you.
Thanks, Ajay. Thanks for your kind words.
You're welcome.